Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Okay, so looking at the recent bearish action, it all started from the failed follow-through higher to both the weekly key reversal up in mid-April and the daily key reversal up on the 19th of April, which also turned out to be an indecisive doji cross right at the top of the recent market. Things then became interesting, as we could then look at the whole action from the heights of March all the way until last week as a large bearish halfway hesitation, with potential target X in the 2030 area. We came very close to target X last week, after breaking down through, and these are in no particular order, the congestion at 2132 to 35, the extension of the lower trend line for the May to June 2021 descending triangle, currently at 2145, and interestingly, the middle time, currently 2127, of the March to April bearish Andrews pitchfork. Prices dropped as far as the lesser Fibonacci line level last Friday at 2058, before bouncing back up to the middle time today. This move lower is not over yet, and we may well see target X being reached, and soon. You see, in addition to this pattern, the action from that same peak on the 19th of April was also a small bearish halfway hesitation, with a potential target X1 in the 2087 area, and this was reached last Thursday. It will be very interesting to see what happens now, because at the moment it does not look as if this market has the energy to rise and pull back over the previously mentioned middle time, congestion and trendline extension, and thus we may well be visiting, as I said, target X perhaps soon. We shall see what the next few days brings, but in the meantime I would like to plant an idea into your mind. You see, just to see if it grows, is regard the whole action of 2022 so far, even perhaps going back to November last year, as a possible diamond pattern. More on this should it develop in the future. LME 3-month tin. The move down below the long moving average, currently at 39080 on Monday last week, with a bearish opening long black Mariposa, was the market finally making its mind up and choosing the bearish initiative after 2 weeks of relative indecision. The drop that day only halted at the 50% Fibonacci line of the March 2021 to March 2022 move at 36945. However, the drop continued the next day, though on Wednesday we had a temporary respite with a combined immediate countering bullish Harami and bullish closing white Mariposa. However, the next day after that, Thursday, saw an even bigger move down with a bearish opening long black Mariposa that dropped down into two congestion zones. The first and smaller one is between 33665 and 33475, and contained the old April 2011 previous all-time high. The second, larger congestion zone is between 31845 and 32985, and it contains the 50% Fibonacci line of the March 2020 to March 2022 move at 31845. The first zone slowed the drop, whilst the second zone finally stopped the fall, at least for now. What was interesting was how the first zone managed to hold up the market on a closing basis, even if it was the smaller of the two zones. Anyway, the drop fulfilled the downside target, unlabeled as it was so close last week, of the mid-April to date bearish halfway hesitation. So what else has been going on here? Well, I did mention last week one other pattern that was in construction. It was an inverted cup with handle pattern for the March to last week action. In last week's commentary, I pointed out that I found it still a bit early for this pattern's full development, and I would delve further into this pattern this week. Well, this week has come, and part of me wishes I'd laid out the parameters for an inverted cup with handle pattern last time. You see, the market's drop since last Monday has already fulfilled any potential targets below. Indeed, by close of business last Tuesday, I had managed to reach sufficient targets below. And what we have seen since, specifically last Wednesday, has been an expected follow-on lower to the original pattern. Thus, all patterns on the downside for the moment have been fulfilled. So where does that leave us now? Well, It very much depends now on the state of the two congestion zones below. The smaller one between 33,665 to 33,475, and the larger one between 31,845 and 32,985. If these hold up, then a gradual move over to test the March to date downtrend, currently at 39,665, sometime in June, might be possible. However, I would like to emphasize one admittedly lagging indicator that should be borne in mind. It is the dead cross of the short stroke medium moving average, currently 41,905, down through the falling medium moving average, currently 41,960. Whilst this may not cause a fresh fall in the market due to the likely quality of support that is underneath, it nevertheless seems likely to stymie and potentially pull back, stymie any potential pullback up. Thus, we may well go sideways for a bit, or at least until we approach the previously mentioned downtrend. We shall see how this develops. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investors International Limited. And here comes the final bit.